47% of Americans say that they can't cover a $1,000 emergency expense, and that includes people making over six figures. So clearly, you can see that being poor isn't just about income. If you don't have a system for the money that you're making, you're going to feel broke no matter what. The difference between then, I think someone who is broke and someone who actually builds wealth isn't about income. It's usually awareness. And in today's video, I'm going to share with you 5 things that are keeping you broke and exactly how to fix each one. Starting with number 1, you have no idea where your money is actually going. I actually spoke to a group of college students last Saturday, and I asked for a show of hands. Out of 80 people, how many people track their expenses? And literally, only one person raised their hand. Avoiding where you stand financially is actually one of the biggest problems that I see because everything else is harder to fix if you aren't even aware of your baseline. In fact, it's quoted that 1 in 3 people would rather deep clean their bathroom with rubber gloves and everything rather than check their savings account. That's according to AJ Coyne, the chief marketing officer at the big UK online bank Monzo. This is a habit that is so common that behavioral economists have actually given it a name, and it's called the ostrich effect. That's where we would rather bury our heads in the sand than face the potential of seeing negative financial information. I did learn for this video that ostriches are just turning their eggs that are hidden under the sand when they do this. So they're not actually afraid of anything, but still the effect is named after them. Now, in this research paper, they found that, quote, people who don't regularly check their accounts show much more volatile spending patterns, especially around payday, and people who infrequently check their accounts tend to spend significantly more on discretionary purchases compared to regular account checkers. So, an easy fix here is to start getting into the habit of checking your finances regularly. Even just installing one of those many popular money tracking apps out there or tracking it with, let's say, a pen and paper or your notes app, that could be a really good step to take in this case. Now, another place where people are wasting a ton of money is simply just subscriptions. So you want to do a subscription audit as well because, according to the data, people on average think that they spend around $86 a month in subscriptions, when in reality the actual amount that people spend on subscriptions is over $219 per month. Almost 1 in 3 people underestimate how much they spend on subscriptions by $100 to $199 per month. It's so comical that I think you have to read this tweet from Trevor Noah. He says, "Amazing how you can subscribe to any service instantly and they take your money with one click. But when you try to cancel, suddenly you need to call their helpline, which is always too busy, and so you have to find a dragon to fly you to Mordor to slay your subscription in the flesh." I know it's somewhat ironic and a little bit comical, but it's true. Most companies make it so easy to take your money as simple as one click in many cases. But when it comes to canceling, they make you jump through hoops or make you take 100 different steps to do so. So, with subscriptions, I would just write down all of your subscriptions in a list somewhere and try to evaluate each one to see if you're actively using it and if it's worth the price to you. If you can't definitively answer that the subscription is worth it to you, then I think that that's a good signal that you should cancel it. So, the takeaways of this awareness section is that you have to start facing your finances, and you also have to do a subscription audit. I think the sooner you actually look at your finances, the better off you will be. Now, here's the thing though. Sometimes you know exactly where your money is going and you spend it anyway. Which brings me to number 2 today, which is that spending isn't just an awareness problem, it is also an emotional one. This one is particularly tricky because spending emotionally doesn't feel like a problem. It may just feel good, or it may make you feel better if you're feeling sad. About 5% of people have what's called a compulsive buying disorder, which basically means that they're addicted to shopping. Now, even if you're not in that 5%, I think everyone still has some sort of version of emotional spending that they might succumb to. For me, personally, whenever I was sad or lonely, I would treat myself to a vanilla ice cream to make myself feel better because I love the taste. That's actually one of my favorite flavors of ice cream. Even though people say they'll say it's the most boring flavor out there, but you know what? They are my taste buds at the end of the day. And I think vanilla is the finest of the flavors. Now, realistically, this would cost me maybe $7 at most. But the point here is similar. If you've had a bad week, you might treat yourself to something, whether that's a sweet treat like me or something that you buy online. And with this type of spending, it might feel good for about 15 minutes, but then the money is just gone. Now, the good news here is that if you're susceptible to emotional spending, you can build a skill to prevent it. Studies have shown that emotional intelligence is negatively correlated to compulsive buying. So, that means the better you are at regulating and recognizing your emotions, the less likely you are to spend impulsively. It's not a personality trait, after all, that you are stuck with, and it's something that you can actually improve. The harder thing to manage, in my opinion, is what's called social spending. That's where you feel the pressure to spend because of what your peer group is doing. On average, people spend $250 a month on activities just with friends. That's over $3,000 a year, which if you watch this channel, you should know that that can compound to a lot of money later on in life. According to Ally.com, 44% of Gen Z and millennials say they've skipped major social events because of the cost. So, you're either spending money you don't have to keep up, or you're missing out and getting FOMO. I think it's a lose-lose situation if you don't have a plan for this type of spending. So, how can we fix these things? I think there are two things that we can do that's really actionable for spending emotionally. I would go through this checklist, and if any of the answers are no to these questions, I would seriously reconsider the purchase. Number 1. Ask yourself if you actually need this item. Number 2, ask yourself if it brings you closer to your financial goals. And number 3, ask yourself if it aligns with your values and if you are clear on this purchase. Just going through this checklist, and if any of these answers are no, you might want to take a pause, and that could actually save you a lot of money. The second thing that you can do for the social spending piece is to actually be honest with your friends about money. If spending money on a lavish dinner or trip will seriously cost you a lot or set you back either for your budget or maybe even just for investing, I think you should say that and vocalize it. You'll have some friends that respect that, and I think those are going to be the true day ones and the true friends that you stay with. Emotional spending and social spending are usually small purchases that add up over time. However, my next point is the complete opposite. It's all about the big purchases. One trap I see people falling for over and over again is that they think since they're so diligent and disciplined with small purchases throughout the month, that they suddenly justify a large purchase of $1,000 or $2,000. Now, sometimes I think it's perfectly fine to make that one-off big purchase, but if you're locking yourself into an expensive recurring payment like a car payment or housing payment, you're going to get in trouble. Cars and housing usually make up 50 to 60% of most people's monthly expenses. So if you get one of these wrong, no amount of skipping lattes or cutting subscriptions is going to help that much. With cars right now, the average payment for a new car is $750-ish a month, and nearly 19% of people who have car payments are over $1,000 a month. The problem people are running into here is that as long as the payment feels manageable, people start to take on longer and longer loans. I talked about this in my car loan payment trap video, but the average car loan term is now over 68 months. And the worst mistake is that once people pay off a car, they go straight into a new car loan instead of driving their previous car into the ground, which would save them the most money. Housing is a similar story. The median price of a new home is around $410,000 to $450,000 as of 2026, and a huge chunk of people cannot realistically afford these homes. So what happens is that people overextend themselves on a loan in order to live the so-called American dream. So what's the solution for both of these issues here? It's abiding by affordability rules. For cars, there's the 24-10 rule. This is still a really great rule. Sometimes you could even go 25-10, but let me first explain what the numbers mean. The 20 stands for putting 20% down on any car that you can buy. The 4 stands for you should finance the car for no more than 4 years. And the 10 means that you need to keep your total transportation costs under 10% of your gross monthly income. Now, you could finance the car for 5 years. That's definitely doable, but the idea is that you want to keep the 10. That's the 10 is the most important there. It's the monthly recurring cost, and that should be under 10% of your gross monthly income. So if you make $84,000 a year, that's $7,000 gross income per month. So your total car costs for that car payment should be under $700 a month, as an example. For homes, you want to use the 28% rule. Now, this is very conservative, but that's where your monthly payment, which includes principal, interest, taxes, and insurance, that should not exceed 28% of your gross monthly income. So, on a $400,000 home, if you add in everything, the payment is around $2,631 a month. That means the required salary to be affordable is around $112,000. Using the 28% rule of home buying, this payment column does include property taxes and insurance, by the way, and I assume that you already had a 20% down payment saved up. Now, you can see that it's much more difficult to afford a home based on the affordability rules compared to what you can qualify for from the banks. Banks will often let you qualify for much more of a house than you can afford, but then what happens is that you get overextended on your loan. The uncomfortable truth here is that the best thing you can do to build wealth isn't always about finding the next best investment. It's just doing these simple little things. Buying less of a car than you can qualify for, or keeping your housing expenses as low as possible. These are going to make the biggest impact for you. Alright, this next point isn't about spending or awareness anymore, but it's all about how you manage your money. Point number 4 is that most people manage their money very poorly. And in fact, 92% of people never achieve their goals, not due to a lack of ambition, but because they just have no actionable plan. And when it comes to money, if you have no plan, you are going to get behind. Because most people treat saving money, for example, like an afterthought. Money comes in, they pay their bills, then they